We're now on to the fourth part of solving the balance day adjustment exam problem. And that's it, we've got to prepare our balance sheet. And you're going to be given this template. So we're going to start by finding current assets, current liabilities, add any non-current assets, take away any non-current liabilities, give us an overall net assets, and then we're going to look at our capital position. But I want to be really clear as you're doing this. Remember, in your chart of accounts, it tells you which are the current assets and the current liabilities. And if you got one in the slot in the wrong place, it's not going to make a difference to the overall position. So let's start with our current assets. So if we go over to our sheet here, and we'll keep marking them off as we go, accounts receivable are a current asset. So let's pop that in to the balance sheet. And that has a value of $82,000. We have quite a lot of people who owe us money. That's obviously a good thing. I just want to get this second spreadsheet out of the way. Okay, the depreciation, they're associated with non-current assets. Cash at bank is going to be a current asset, and we've got $33,000 there. The building isn't. The office equipment won't be a current asset. Inventory controlled, if we look, and again just check, in our asset account, it is a current asset. So inventory control, $43,500. Remember, the control just means total. Asset is not going to be a current asset. These are not, they're going to be considered non-current assets. However, prepaid expense and accrued revenue, they're both going to be considered current assets. So if we start with the prepaid expense, which was $1,000, and we go to the accrued revenue, which is $4,500. We can now make a total of all of these assets. All these current assets, I should say. So we have $164,000 in current assets. So now we're going to find that we're going to have to pay some current liabilities. So let's go through and find our current liabilities. Right at the top, we've got $33,000 of accounts payable. I saw in there that GST clearing that's the current liability, $2,200. If we go through, the mortgage is not considered a current liability. However, and accrued expense would be an unearned revenue, both are. So an accrued expense of $3,300. and unearned revenue of $2,200. So we can total these up now if we want and say, okay, these are our current liabilities of $40,700. So after current assets and current liabilities, we just put this in, we've got a balance situation of $164,000 minus this $40,000. So now we have to add in any non-current assets. So we might just pop a few more rows in. And let's have a think about what other assets. So basically we're going to put all the other assets in here. So if we go to the ones we've got, if we go through there. Now, we need to put, let's start with the office equipment. So we've got an asset office equipment of $85,000. There we go, non-current asset office equipment. And it's $85,000, but it's got to be less accumulated depreciation because that takes into account the amount that it has fallen in value over time. So that's $18,500. So when we take those two things into account, the value of our office equipment is going to be this minus that. So $66,500. Let's do the same thing for motor vehicles. Okay, the value of the motor vehicle is going to be $62,000. Less accumulated depreciation, which up to this point is $24,800. So the value at the moment of that asset is $37,200. So we're going to have a couple more. Now we need to get any other assets that we have through here. So we have the licensing agreement, which has a value of $1,200. But it's got to be less accumulated amortization, which is $600. So it has a value of the $12,000 less the $600 of value that's been used up. And we have then the last two assets, a building valued at $140,000. And the government bond, which is valued at $20,000. So we can now add up our non-current assets and say, okay, we've got $275,000 worth of non-current assets. We can add those to where we started, And so we've got a value of 398,400, but we're going to have some liabilities that we might have to pop in here. Let's get us a couple of rows. So the non-current liabilities, if we have a look at what we've got left in there, we'll just mark off that we've used the government bond. So actually the only one we've got there is the mortgage, which has a value of $95,000. So the total for the non-current liabilities is going to be $95,000. And so at this point, this is where we were previously. We take away our non-current liabilities, so we're left with $303,400. And this figure here are our net assets. Now we've got to start looking at our capital. Right, so we've said our capital account is, if we look at our capital, 323,400. Now, to that, we have to add our net profits. So our net profit is 115,000 less our drawings. So if we do the calculation for that and say okay, it's equals that plus our net profit less our drawings, $44,000. Now, I'm just a little bit concerned because it doesn't look like it's going to balance 433. So the thing that would appear to be probably out is my capital. So if I just go back to my capital account and check that, it's actually 232,400. So I've just making a mistake transcribing it, 232,400. We then add in, so we add our capital and our net profits. We take away our drawings. So if we go to there, we find out our drawings account is $44,000. And that should give us our final figure on the capital side. So that, less our drawings, is 303,400. And fortunately, that equals our net assets. So we can be happy that our balance sheet has balanced. And that's the 4 steps of solving the problem that we have to do.